Good morning, Mr. Manuj Nikhanj. Thank you very much for doing this. I really appreciate your time.
Absolutely. You got it.
For the listener, you're the CEO of Enverus, but what is Enverus?
So Enverus, we are the world's largest vertical software service provider to the energy space. So we provide technology, data, intelligence to energy customers across the world. Say 85-90% of our customer base is in North America.
And for context, about 1,700 employees and revenues are approaching $1 billion, I think.
Yeah, we're about 1,800 employees now. We continue to grow and not quite billion Canadian dollars. Yeah.
Which is impressive.
Yeah.
You've also recently sold the company, I think, to Blackstone for about $6 billion, making it one of Canada's most valuable tech companies. So congratulations.
Oh, thanks. I appreciate that.
So things are going well.
I mean, they're going well. Yeah, absolutely.
And for the listener, you were named CEO last year, I think?
Yeah, that's right. Prior to that, I was president of Enverus, but I've got a pretty long history of how I got here. My entire career has actually been in some shape or form in the energy business with offshoots of basically Enverus from predecessor companies. So.
And although the website says you're headquartered in Austin, the company is more or less revolves around Calgary, Canada?
Yeah, so of our 1,800 employees, I would say our Austin and Calgary presence is pretty similar. Calgary, we probably have a few more individuals. We're about 300 employees now in Calgary. So it is our biggest office across all of the offices we have globally.
So good Canadian presence.
Yeah, very good Canadian presence, yes.
I got to say, you also look about 30. So I think you're
I wish.
a little older than that. So you must be doing something right on the aging front too. So
I appreciate that. I'm pretty avid, pretty consistent with my workouts. That's first thing in the morning. That's the first thing I do. So Gets me going for the day. I have been consistently working out since I was 12. So I'm 47 today. So for 35 years straight. So
paying off.
Yeah. Hopefully.
And so maybe to go back to the beginning, are you from Calgary?
Yeah, I was actually born in Michigan, but I was literally just born there. But I've lived in Calgary pretty much my entire life.
Went to school at the U of C, I think.
That's right. Went to University of Calgary. I did my Bachelor of Commerce in finance, and so I have a finance background. Did my CFA, for those that know what that is. Grueling test, but just focused on finance originally out of school. So
was the plan to get into energy always, or what were you thinking of coming out of school?
Yeah, just being in Calgary, you knew that I wanted to be in finance and I wanted to be energy related, just given that's what you grew up around. And so, the plan was always energy, but more from a financial market standpoint.
And so first job was at RS Energy Services?
Yeah, no, so my first job was with Ross Smith Energy Group, which eventually became RS, and I can give you a bit of the history down the road. But I joined Ross Smith Energy Group as one of the first employees back in 2001. And Ross Smith at the time, it was a startup boutique independent energy research shop. And so I remember I was brought on by Alan Ross, Mike Smith, and Jim Jarrell as a consensus analyst.
Mm-hmm.
So basically trying to understand what consensus was on the street as it relates to energy equities and energy companies, and seeing if there's a counter consensus view based on all of the data and analytics that we had at our fingertips.
With the energy sector?
With the energy sector specifically, yeah. But the main focus back then was primarily on institutional investors, so hedge funds, pension funds, mutual funds. But remember when I started, we didn't really have many customers. It was really a startup at that time.
That was the early 2000s, and RS was started by Mike Smith and Alan Ross, former Peters & Co., I think.
That's right. So Alan Ross and Mike Smith started Ross Smith Energy Group. And I'll get to the RS story, which is like the reincarnation of the Ross Smith brand. But Alan Ross and Mike Smith, yeah, extremely successful institutional sales individuals that used to work at Peters and Company. So,
and they had the idea to do their own research firm and started it out on their own, basically, in a nutshell.
Yeah, so I think the way to think about it, I think that the original idea around the business was that there was a lot of investors investing in the energy space. Typical investments were being done with doing, multiple type math, like multiple of cash flows or whatever, multiples of earnings to come up with whether a energy stock was an attractive buy or not an attractive buy. And the original idea was that there's tons of data available in the energy space because whenever you're severing minerals out of the ground, a lot of that has to become public records. So the idea was like, why don't we staff a business the same way an energy company would staff itself with geologists, engineers, financial analysts, but rather than us going out and evaluating companies' assets plays to buy them, right, or acquire them, let's package up those insights in the form of research and then sell that to institutional investors to give them a real data-driven approach and real fundamental asset-driven approach to understanding investing in the space. So all the things that are common now of looking at, inventory and type curves and all that sort of stuff. Like back in the day, that never really existed. Remember, shale wasn't even really a thing at that point in time. And so it was quite black box. And so I'd say Ross Smith back in the day kind of were the innovators or disruptors bringing those new techniques to the institutional space.
And they would sell those insights as a package to clients who use it to make better investment decisions, I think.
That's exactly it. So if you think about it would be like an annual subscription, right? Ross Smith never had any investment banking. So we never had misaligned incentives with the investors around back in the day, especially like investment equity research wasn't super independent, and there was always tended to be biases to try to win banking business from energy companies because that's where really you got paid. And so the idea here was independent research. We say it as we see it. We do our work. We don't care if the answer is good or bad, but we're just going to tell what we believe. Now, it doesn't mean you can't be wrong, but taking a very unbiased approach and then selling that research on an annual subscription basis to institutional customers.
And so it was RS, and then it was RS Energy Services, or what was that transition?
No. So I've gone, me personally, have gone through 6 iterations of somewhat the same business. So started out with Ross Smith Energy Group where, we were private. There was, 5 partners in the business. I was one of those partners. And then we sold it. That was again, I joined in 2001. We sold the business in 2011 to a Wall Street brokerage house, a publicly traded Wall Street brokerage house called ITG. And that was from 2011 to 2015. And then in 2015, we carved the business back out to be standalone again with the backing of Warburg Pincus. Renamed the business from being a part of ITG to RS Energy Group. And had the backing of Warburg Pincus from 2015 to 2019. And then from 2019, we sold the business to Enverus, where I stayed on as president and ultimately became the CEO. But even when we went to Enverus, it was Genstar Capital-backed company out of the West Coast. And then about a year and a half or 2 years into that ownership, Hellman and Friedman came in and bought majority interest in it. And then set to close in the next month is Blackstone acquiring the business from basically Hellman and Friedman. So
this episode is brought to you by Bunch Projects. Bunch is a construction-led engineering and EPC partner supporting Western Canada's energy industry for more than 45 years. Bunch combines practical field-driven engineering with data-driven planning to improve predictability and support cost certainty. From well pads and compressor stations to gas plants and energy development, Bunch focuses on construction, clear communication, and consistent results. Bunch construction-led engineering is built on trusted partnerships and proven performance. Learn more at bunch.ca. But you were able to get involved as a partner early on when you were young. Did you seek out the company to become a partner? And did you say to yourself, I want to work here? Or how did that all happen?
It's a pretty funny story. When I graduated from school, there wasn't like the job market wasn't great, right? I had decent grades. I didn't have a ton of work experience. I wanted to, like every person that comes out of finance, be an investment banker. Mm-hmm. So I like interviewed at like so many jobs. I would literally make it to the last round, and like every single like interview, I'd make it to the last round. And then it was always a work experience where like, or maybe they just didn't like me, but at the very end, I wasn't able, like I wouldn't get the job. And then eventually I interviewed for a trading position at JF Mackey, which is like a, boutique kind of wealth management firm. And I interviewed for the job. It went amazing. And, they had told me that like, hey, this job is yours. You just got to do this personality test. I'm like, okay, what's this personality test? It's called a Kobe. So they made me write this personality test. They bring me in. They go, Manuj, this basically says you would hate trading. And so I was like, so I was bummed out, right? Because like I had interviewed at so many jobs trying to get them. And I was like, oh man, another one I'm not going to get where I thought I was going to get it. And then this is a time, like, I don't even know if cell phones were that big a thing at the time. And I think I was studying for the CFA at the time. And then I got a message from Jamie Mackey basically saying, hey, Manuj, like I got a friend of mine, Alan Ross, that's starting this business, or that has started this business called Ross Smith Energy Group. It's a research business more aligned with what your personality test shows. Are you cool if I send him over your resume? Because I really think he should talk to you. Anyways, so I was like, yeah, absolutely. I wanted a job. So I remember coming home after studying at the University of Calgary for my CFA. And on my answering machine, so I'm really dating myself, there's this long message from Alan Ross, basically telling me about Ross Smith and, hey, why don't you come in and let's have a conversation. And Jamie Mackey says great things about you. Anyway, so I came into the Ross Smith office, and they basically made me, I interviewed with Mike Smith, Alan Ross, Jim Jarrell, and they made me an offer on the spot. So that's literally how I got the job.
So that's some irony, because although you didn't get the iBanking job, you just bought out by Blackstone. So it seems to have worked out.
Yeah. Well, thanks. I mean, we got a great team, so makes it easy when you got a great team behind you.
And so were you nervous the first day at Enverus, or was it an adjustment? Or I guess it wasn't Enverus, it was the RS at the time.
Yeah, no, because basically from 2001, right, when we were half a dozen to dozen people, Ross Smith Energy Group, we were all like pretty much building a business at that time. So, the small team of partners, right, we're all basically, running the business, coming up with the ideas, creating the business plan. And then when we went over to ITG, Alan Ross and Mike Smith retired from the business. Myself and Jim Jarrell were basically co-leading the business when ITG bought us. And we were basically running like a standalone business. So this Wall Street brokerage house bought us. They loved our independent research for them to provide alpha generating ideas for their trading customers, right?
Mm-hmm.
But we basically ran as a standalone business. So, it's interesting. We went from, Ross Smith went from zero revenues to like 15 million of revenues between it bootstrapped, Alan Ross, Mike Smith money. Like we didn't get any outside capital from, whatever the founding of the company, I think was 98 or 99. But between that and 2011, when we sold to ITG, we took it from zero revenues to 15 million of revenues. So it was always quite a profitable business. We only had 30 employees at the time. And then in 2015, when we sold to ITG, Jim Jarrell and myself continued on with the business for, the next few iterations. And so we were basically running that division within ITG. So we were still running the business. And then without, being owned by a brokerage house, they don't want you to spend a whole lot of capital. So we were able to double the revenues from 15 million of ARR to 30 million of ARR, but still with like 30 people on staff. And because we worked with the entire institutional investor community, like we had, hundreds of institutions that use our research and intelligence. We worked with all the major private equity shops, all the hedge funds, all the pension funds. And I happened to be in like Warburg Pincus's offices talking to all their portfolio companies, telling them what's going on in the market. And how RS came to be is I was like, walking to the elevator after doing this presentation to all of the portfolio companies that Warburg was invested in. And one of the partners there was walking me to the elevator. He's like, "Hey, Manuj, like you guys have have built such a great business. You have the best research and intelligence out there. Why don't you come over and like, let's, we can back you and we can find an idea for you to do something." I'm like, "Man, I don't want to start all over again. We just spent, 10, 15 years building this business out." I said, "You know what? Let me talk to the CEO of ITG. We're kind of running as a standalone piece within ITG. Let me see if they'd be interested in us carving the business back out." The reason being is like we doubled the business within ITG with the same headcount. So it was going to be a good outcome for ITG versus, what they paid us and what Warburg would pay for it. And the CEO of ITG is like, yeah, like that sounds great. And so we carved ourselves back out. That's basically, it wasn't like a big marketed deal or anything like that. And that's how Warburg entered into the business. And we carved out from ITG. We hired like this agency to be like brand agency, like give us all of these ideas, all of these names that we can name the company. And man, there were some bad ones. It was like Lion Sight and like all these like weird names. And then after spending whatever $30,000 or $40,000 on this brand agency to give us all these ideas for rebranding our company, I remember Warburg even had a naming competition and we had all this competition. And then at the end, we're just like, why don't we just call it RS Energy Group? Like everyone still, even within ITG, used to call us Ross Smith or RS. So we're like, let's just call it RS. And so after spending all this money on brand agency, we didn't use any of it and we just called it RS. so that's how RS came about. And at that time, like I said, we were about 30 million of ARR and about 30 people on staff.
And at this time owned by Warburg Pincus.
Warburg Pincus, yeah.
Oh, okay.
Yeah,
right.
Yeah.
And so that went along pretty well until roughly 2020.
Yeah.
We're going great. And then you did another deal, I think. You were either acquired or you merged with Drilling Info, Alan Gilmer?
Yeah. So so from Warburg, we scaled the business. There were, amazing partners. We were primarily independent research at the time. We carved out of ITG. Then we said, with Warburg's backing, how do we scale this business to the next level? And the idea there was, us building out all this research, being data driven, we know where all the data comes from. We were using a lot of third-party sources at the time, including, Enverus data at the time, and some of the other providers out there, IHSs of the world and things like that. And then what we were finding is like there was a lot we had to do to the data before it was analytics ready for us to run our analytics to do the research. And remember, research was static PDF research reports.
Mm-hmm.
So we said, like, what if we vertically integrated the business so we own all our own data and put all of that, 10, 15 years of domain expertise that we've mastered to make the data extremely valuable, right? On top of the data that we would then go to market with for an analytics platform. And so we went from being a pure research provider, right, to starting to building out our own technology capabilities, our own platform, and our own data and analytics within that platform. So we packaged up everything that was in all of our analysts' heads, right? And all of the algorithms that we used to run, all of the cleaning we used to do to the data that was out there, right? These are thousands of sources of data. And we vertically integrated the business rather than using third parties to build it out all by ourselves. And that really took off. Apparently there was like a huge need for that in the marketplace. And so we went from 30 million of revenues or ARR, and by the time we sold in end of 2019, 2020, right before COVID, the business was close to 100 million in ARR. And we went from about 30 people on staff to close to 250 to 270 people. So we scaled it really quickly.
And so when you were acquired by Drilling Info, I think that's when it became Enverus. How did that work? Or what was that transaction?
Yeah, so Drilling Info, Austin-based, Alan Gilmore, amazing entrepreneur, and, kind of had the same sort of lineage of Ross Smith in the sense that rather than focusing on independent research, they were focusing on data for the energy customer base. And so Drilling Info basically grew their business in parallel to like when Ross Smith was growing its business and had its own journey to get to Enverus, and Enverus rebranding and name happened a few years before the RS acquisition. So it was already called Enverus. They were also private equity backed at the time. And they did an amazing job of acquiring additional capabilities in the energy industry to expand their platform and their technology beyond just organic growth that they were undertaking. So they really did a good job at bringing kind of a very complete and comprehensive data across multi different facets that you would look at across energy in one place. And so by the time RS, so Enverus, like to be fair, Enverus or Drilling Info and RS were actually pretty competitive with each other from during our Warburg days, because we started to get into their space as it relates to the data and analytics and the technology side of the equation. So we were actually pretty head-to-head competitors. And Alan Gilmore and I always used to joke that like one day either you're going to buy me or I'm going to buy you, right? Like it was always a running joke. And their business scaled quite well, not just organically, but then also they got, quite acquisitive, doing 15, 20 acquisitions to bring in a lot of the smaller players in the space and bring a consolidated data offering to the energy markets. So when RS eventually went to market in 2019, Enverus was the winning suitor. And so, at that time, you're just like, it's like two rivals coming together, right? And so, so you had the combination of two rivals coming together, but both very competitive, which was great. So you always have your cultural hurdles when that happens, and integrations are always tough. And then on top of it, I think a few weeks after we closed, COVID happened, everything shut down. And so you got two rival companies coming together, and you can't like even hang out together. Right. So it was an interesting time. But it was for sure the right combination.
So how come they acquired you and not vice versa? What led to that?
I mean, they were just a bigger scale at that point because they were quite acquisitive in nature. And so they were probably 2 to 2.5x our revenues at that time. And so I think when we combined, we're probably like 350, 400 million combined of revenues or ARR. And we were, 25 to 30% of that. So we were the largest acquisition that Enverus had ever done, but they had done multiple other acquisitions before that.
And at the time, you were not CEO. You were, what was your role at that time?
Well, I was the CEO of RS Energy, co-CEO of RS Energy Group, myself and Jim Jarrell. And so when I joined Enverus, I think they originally had me like general manager of energy analytics, which was like our combined division. But the plan always was when they acquired us that I would become CEO of the business. I remember the first day that we closed. Once we closed, Jeff Hughes, the CEO of Enverus, sat with me and said, "All right, Manuj, now that we're closed, like let's figure out, like you're ultimately the CEO of this business. Let's figure out your path to get you there." So it's a very collaborative,
that's great.
Yeah, partnership.
And so you went where things are going well, but then Blackstone came along. How did that transaction originate?
Yeah, so typical like private equity, right? So you're usually going to live within a 3 to 7 year cycle. So one thing that is always guaranteed with private equity is that you will sell the business one day, right? Even with Blackstone now, it's like, eventually we will sell. That's just what you do, right? And so, because ultimately they got to, make investments and generate returns for their limited partners. And that's the name of the game. So with Hellman and Friedman, our current majority owners before Blackstone came in, right? We were running over 4 years, right? So we were approaching the sweet spot window of when private equity typically likes to go to market and monetize. And, the business performed quite well. I think when Hellman and Friedman came in, we were around 420 million of ARR, and we had scaled it to, like the Blackstone deal hasn't even officially closed yet. We'll give it another, probably in the next month or so. And so we'd scaled the business to, where we're at today. So 420 million US to, whatever it is, 670 million US-ish today. And so it was just the right time for Hellman to, capitalize on the performance of the business.
That's a great transition to have. Did you get to meet Steven Schwartzman?
Not yet. I did. I was actually in their offices last week for a meeting in their office. I did see him from a distance. I'm sure I'll get a chance to meet the legendary investor. So excited about that.
Good person to have on your radar.
Yeah, exactly.
And so, fast forward to today. If you were to sum up the Enverus business model for someone that is listening, how would you describe your offering and the value proposition for the company as of 2025?
Yeah, that's a good question. So today, like Enverus, like I said, we're the largest software as a service provider to the energy space. So today we work with over 8,000 customers, 200,000 users, and our offerings include data analytics, insights. We have one of the largest digital networks for, invoicing and producer partner type relationships. So every year across our networks, we have about $500 billion of digital records being created using Enverus systems across the energy space. So probably we probably work with 95% of the oil and gas industry. And then over the last 5 years, we've built out quite dramatically our power and energy transition business, which was basically non-existent 5 years ago. And now it's probably one of the biggest power and energy transition businesses globally, I would think. And so to sum it up, it's we help our customers really do two things, right? We help them run better businesses, right? By making, higher quality decisions. So basically creating a digital twin of everything that's going on so they can de-risk decisions that they might make, whether it's through operating, through building, through acquiring, through divesting. We like to think all of the things that we provide and the intelligence that we provide help drive significant ROI by reducing risk around decisions the industry makes. And then we help our customers run more efficient businesses. So a lot of the technology and capabilities that we've built out help our customers do things much more efficiently than what they would have traditionally done. So we're really helping our customers automate workflows, create digital records, basically like allowing you to get leverage out of your organization. So really, if you boil down our business, that's how we help our customers.
So maybe in a nutshell, companies, institutional investors, or anyone involved in energy would pay Enverus maybe monthly or annually a fee, and you support a variety of digital services for the companies to help them perform better.
Yeah, that's exactly it. And we work with everyone of all different customer types, sizes, functions, segments, subsegments. So we work with everyone broadly across energy. Like one of the interesting things about energy in general, it's a highly fragmented space. There's a reason why there isn't like 5 Enveruses out there, right? So there's a lot of small providers that might provide point solutions, or you have legacy providers that are in the space that just haven't innovated for the last decade, right? So what we do is we help make intelligent connections across disparate workflows, disparate data sets, disparate systems. And by connecting all those things, we drive significant value to the customer, where you take 1 + 1 = 3 by making those connections. So it's easy to describe on paper, but very hard to do from an execution standpoint, right? And so, we've been acquisitive. We're a very fast, double-digit organic grower, but at the same time, we've also been acquisitive. But when we buy something, it's not just to collect companies, right? Because that can paralyze you and slow you right down. Everything we acquire, we do a buy versus build decision. Like, can we organically build this more efficiently and better, leveraging all of our capabilities that we have in an organization? Or should we buy something because it's a skill set or a capability or a data set or an analytic set that we just know we'll never be good at? And then from day one, we're always thinking about product synergies for our customers. So like, how do you take the thing or the asset that you bought and combine it with all of the other capabilities Enverus provides to create new value to a customer that wouldn't have existed, right? Unless you did that combination. And so we've been very intentional on that. Otherwise, you can collapse on the weight of yourself if you collect things, you have different systems and different processes, eventually that just slows you down.
So if you're traditional energy company and you were to come to Enverus, what would be an example of a product that you would point them towards that maybe you'd show them immediately?
I mean, so we do a lot of things for a lot of different customers, but one of our flagship products and platforms is all of our data analytics capabilities as it relates to like a digital representation of everything that's happening, say in oil and gas or in the basin. And so, every well, every permit, every production curve, every type curve that gets forecasted, all of the subsurface data across millions of logs, all interpreted, petrophysical, geologic characteristics, four-dimensional spacing models, economic models, valuation models, benchmarking capabilities. It's all of these foundational data sets that is a foundation of everything that we do. And so it all starts with just like the best data foundation. Then it's processing that data to be analytics ready. It's creating high value analytics on top of it. And then it's delivering it through technologies and technology platform that would allow you to get visibility into things you wouldn't have had visible, right? So we basically have we have data going back to the 1900s, but when we talk about oil and gas, we have GPS units on all the rigs. So when we look at rig counts, if you look at where the source of that data is, you'll see that we're cited, right? If you look at data that's in the EIA, look at a lot of the sources of that data. That's all coming from, not all of it, but like a bunch of it's coming from Enverus being a partner, with the governments around that stuff. So.
Yeah. And so a lot of the data in the energy sector is public, but Enverus combines some of your own proprietary data with the public data sets and gives that to the energy companies as a value add.
Yeah. I mean, so to your point, like there's a lot of publicly available data, but in the form in which that data comes in, the frequency, there's always changes. Some of it doesn't exist anymore, right? We've got data back to the 1900s, like I said. A lot of it is proprietary to create. So like I said, we have like GPS on rigs, like that's all proprietary to us. Using satellite imagery to identify where frac crews are. Well, you can only do that because we have all the permit data, so we know where to look. So like it's all of these things combined. That the data in itself on a standalone basis isn't the value. It's the 20 years of know-how on how to combine it, how to prioritize it, how to create the data that's actually useful. That's 100% proprietary to Enverus that the industry basically runs on, right? And so the value is all in that. There's a lot of little data companies out there, but it's the stuff that you can actually make tens of millions, hundreds of millions, if not billions of dollars of decisions off of, right?
Interesting.
So we sit in the center of it all, right? If you're in, oil and gas, you're using our data, and then the power and energy transition side, same thing's happening there, right? We work with over, I want to say, 14 or 1,500 customers in that space as well, right? In the same fashion. So.
And I read one of the reasons Blackstone was interested in Enverus is because of the data you have on the power generation and the emergence of power market demand with AI and data centers. And so what trends are you seeing in that area with power demands and AI?
Yeah.
It must be emerging pretty strongly.
Yeah, like I think, honestly, I've been doing this for like 20 plus years. Sorry, almost 25 years. Geez, I'm aging myself now. But I've never seen an environment where there's so much tailwinds around just energy in general, right? So if you look at like, especially power demand, right? So like we're obviously seeing a structural shift. You can't listen to a hyperscaler's earnings call without them talking about energy, the need for energy, right? Data centers. And so we're going from a world where, for example, power demand has been relatively flat historically to, depending on who you believe or what you want to believe, right? Over the next decade is going to grow, 30, 40, 50%. And the real question is how are we as a sector going to meet the demands that are coming our way, right? And the intersection between molecules and electrons, right? Electrons being, or you can even say, the bits and bytes out of the data centers, those connections are getting stronger and stronger, right? So we're the only company that really connects all of those capabilities together in one place, whether you're looking at, where's stranded natural gas and midstream infrastructure that could support, behind the meter power generation, right? Who are you going to go to? Well, Enverus has made all of those connections, right? And if you look at it, like the entire industry, right, is no matter where you play, especially if you're a natural gas player, like that's all you're talking about right now. And so it's a pretty unique and interesting place to be. And I think from Blackstone's perspective, what they saw is obviously they're betting big on the secular tailwinds as it relates to energy and energy demand, and they wanted to play it through the best player in the space, which arguably I would say is Enverus. So
Yeah.
I'm biased, but
A little biased, but money talks too. So.
yeah.
So what does the data suggest in terms of the magnitude of power demands and the regions that are seeing the most?
Yeah, I mean it's widespread kind of everywhere, right? So it's not just about like where projections and what you need. Like these are heavy infrastructure projects, right? And they're massive, and there's supply chain issues, and there's permitting issues, and there's societal issues around like, not in my backyard type stuff. But the reality is like, whether you believe you're in an AI bubble or not, to me, that's more just around market and market valuations for a lot of these AI stocks. But this stuff is here to stay, and it's, it's real. And so, and the data telling you is like everything is up and to the right, and you can pick your slope. And that's just a change in trajectory of what's happened historically, right? And so energy demand is only going up and to the right. And then the question is how are we going to meet that demand? And Enverus, is and will continue to be, or, aspire to be the operating system for the industry where decisions can be made, right, more efficiently and more effectively.
So how is the power demands being met now? Is it a shortage? Do you see opportunity for natural gas even more? What are you seeing?
Yeah, I mean, again, like I think it's like all of the above, right? So there's definitely a shortage. There needs to be more build out. The interconnection queues are jammed up, 70, 80% of projects that are in the interconnection queues, never really see the light of day. So it's just beyond it's beyond just wanting to build something, but a lot of the infrastructure that's in place around like transmission is aging and dated. And so it's an everything problem, right? From the standpoint that we'll figure it out. But there's a lot of things that need to come together. And the reality is because you've got the biggest industries in the world focused on it with the deepest pockets, all of this stuff is going to go slower than what we expect. It always does, right? So it's going to go slower than what we expect, but the reality is there's just so much capital chasing this space that it'll get built out. It's the pace at which it gets built out, and the form in which it takes. But it means like, whether it's natural gas or whether you're talking about cleaner coal, whether you're talking about renewables, right? Whether you're talking about nuclear, you can argue what the
sources.
what the sources are going to be and by what percentages, and depending on who you ask, you'll get different answers. But you need it all,
right?
So.
And so the source of all that power demand is AI and data centers and hyperscalers and all the tech industry, which I'm not an expert at, but another term is the hyperscaler. Maybe for the listener, what is a hyperscaler and why do they need so much power?
Yeah, I mean, it's just think about every time you use your phone and use anything on your phone or anything on the internet, right? You're hitting a data center. And with LLMs and AI, the use of every query is greater than a typical Google search, let's say, for example. And the efficiencies are always improving from that standpoint. But the pace of adoption as it relates to generative AI, whether it's consumers or whether it's corporations, that pace of adoption is occurring at a pace we've never really seen in history. And so that's not slowing down. It's just going to be a part of everything that we do. And what that means is you need the infrastructure in place to support, right? To support that demand. And so that's where the world is going. And we haven't even gotten into the really robotics taking off yet, and all of the other things beyond. Everyone talks ChatGPT, but there's a million other things that are going on that are going to take advantage of just technology in general, and that just means more power demand, right? Because it all runs on power.
Alberta has, depending on who you ask or look at, what you look at, 6 to 7 trillion feet of stranded natural gas assets. And it could be argued it might be the lowest cost source of energy in North America. Do you think there's a lot of opportunity there for Alberta to supply natural gas to power companies and tech companies?
Yeah, absolutely. Absolutely. I think like for, kind of reliable base load power, right? Natural gas, especially if you like clean natural gas, if you can do it, is definitely a go-to source, right? Especially stranded natural gas. And a lot of these data centers, right? Governments are saying bring your own power because people don't want you just tying into the grid that, every consumer is into because they're worried about power prices, right? And just the size of some of these, some of the demands are just so huge. And so there's a huge opportunity. And this is what I mean by the intersection of the natural gas producers and midstreamers with the end users or the hyperscalers. There's going to be a tremendous amount of opportunity, right? And so, natural gas demand between, not just like data centers, but LNG, like our expectations, like if you look at the US, you're north of 100 BCF a day of production is in the next decade, is going to be 20 to 40% greater than what it is today. And so again, that's driven by demand for all these things.
Power demand.
Yeah, it's power demand. And power demand's not just, data centers, but it's just industrialization, reshoring. It's some areas of the world, population growth. We know there's a direct correlation between the energy consumption and basically quality of life of individuals, right? Those nations that use more power typically have higher quality of life for its citizens. And, that correlation hasn't been broken, right? And so the demand for energy, even outside just purely the data center demand, is only increasing over time.
I think that North America is prepared for the energy demands that are coming its way.
I don't think so, from the standpoint of how quickly we want it to move. There's just a lot of these are, like I said, these are big infrastructure projects, and they're always slower than you think.
Mhm.
Right? You can build a data center in a year and a half, but it's how do you get the power? For natural gas turbines, it can be a 3 to 5 year wait because there's backlogs. So all of this stuff will just take longer. Connecting it to a grid, connecting it to the rest of the infrastructure, all of that's getting the water sources you need. All of that stuff requires permitting.
Mhm.
Like it's not like, it's not like you just snap your fingers and it happens.
Exactly.
And so there's a lot to consider there. And so it'll happen, but probably at a pace slower than what people would want it to happen in.
So what do you think the biggest hurdle is to connect Canadian natural gas producers to the demand of their product? Because right now it seems like it goes such a low price and we can't get good pricing in the markets. What's the problem?
Yeah, I mean, like we just have such a prolific basin, right? You think Montney, Duvernay, like there's just so much natural gas and no egress to get it away, and LNG is going to help and all that sort of stuff. But I think that's one of the reasons, not only weather and all that sort of stuff, why Alberta is quite attractive for a lot of the data center build out. And it's going to happen, right? Like the build out is happening.
Mhm.
It's going to happen globally. It's going to happen in North America. So the more that Alberta can participate in that pie, the better off it's going to be for the economy going forward, right? Because the economy is just becoming more and more digital, right? So you got to less think about the MCFs and how do you get those to become electrons, and the electrons, ultimately is going to, drive the economy, right? Through basically all of the build out that's happening. So
another side to your business is, like we said, traditional energy. You see a lot of data on active basins and wells, everything. So where are you seeing the most activity, maybe to start at the top in the basins, and what trends are you noticing in that area of the business?
Yeah, I think, it's the usual suspects, like that, like Permian Basin, right, is going to be the most active out of anywhere. So I would say, generally speaking, right, rig activity has come down over time, just in general, as people have become more efficient and as they became more capital disciplined over the years, right? Remember, a lot of energy companies back in the day had a lot of debt on their balance sheet. They were spending, outspending cash flow, and now it's a quite disciplined, calculated approach. And so, I think on the oil side of the equation, especially like, say, you look at U.S. oil production, it's 13 million barrels a day. It's getting close to peaking, right? And so, but that doesn't mean that it's still not the amount of capital that gets put to work isn't massive. And I talked about natural gas. Like, natural gas supply will continue to grow just because the demand is there, the resource is there. But just think about, I'll use the US as an example. So 13 million barrels a day, right? The base decline rate on oil production is 25 to 30%. So just to stay flat, right? Industry needs to replace 3 to 4 million barrels a year just to stay in the same spot. That represents 150 billion. It's over $100 billion of capital that needs to be spent just to stay in the same spot.
Yeah.
when production is growing, say 400 or 500,000 barrels a day, right? Like say like last year or whatever, what that means is industry replaced that 3 or 4 million, and then they just did 500,000 more. So when you look at the headline number of whether like US is growing or not growing, right? That's the stuff on the margin after you've replaced what's declined in a given year.
Mm-hmm.
So the difference might only be like, rather than spending 170 billion a year, you still have to spend 140 billion a year. But at the same time, right, the tier one inventory is getting deteriorated. And so the cost to extract resource in the US, there's no shortage of inventory. Like it's a resource play. There's, you know where the oil and gas exists. It's in the source rock. The question is, how economical is it to extract it, right? And we know a lot of the low-hanging fruit is kind of falling behind us, not just from a quality of rock perspective, but, you know, parent-child issues and all these other things that happen in oil and gas. But we would expect over the next 5 to 10 years, right, your average break-evens for U.S. or North American shale, especially on the oil side, is probably going to go up $10, $15 a barrel. And if you believe the U.S. is the marginal barrel that sets prices because it's short cycle and you can bring it on fast and you need it, that just means, right, prices just have to go up over the long term. And in the midterm, right, or the short term, you have an oversupply. But over the long term, we're quite bullish on both oil and natural gas.
Yeah. The other side to the exhaustion of tier one inventory in the States with the shale is that the recovery factors so far have only been single digits, and that perhaps you can bump them to double-digit recovery factors. Also, if you get up to $70, $75 oil, you've got pricing power to boost production in the U.S. shale too. Do you see it that way? And there's still lots of room potentially for those assets?
Yeah, I think so. Like, I think so. I think it's
easy to be a doomer.
Yeah. No, I don't think it's doomer at all. I think growth is going to be harder to come by.
Easy, yeah.
Just given the base, right? Like if you think about, you know, when you're starting at a base of 3 million barrels a day versus 13 million barrels a day, say on the crude side, you just have a bigger base that you have to replenish each year just to maintain at your position. And then if the quality of what you're drilling and the productivity that's coming out of the ground is reducing and the cost is increasing, right? It's just more capital intensive to do the same thing. But it is price sensitive. If oil went to $110, right? And companies are reinvesting 50, 60% of cash flow back into the ground, that's more capital they can put back in the ground, right?
Yeah.
But at the same time, right, you've had more consolidation over the last 4 or 5 years, so less players to deliver that resource. And there's a huge focus on costs. How do you drive down? It's a commodity business, right? So you have the rock that you have, unless you go out and acquire something. So what are the controllables you have, right? How do I optimize development? What's the sequencing I should do? What's the resource I have left? And then how do I drive down costs out of the system so I can have more dollars hitting the bottom line, which gives me more dollars to reinvest. And so I don't think the industry is going away anytime soon, but obviously double-digit growth rates in production are going to be a thing of the past for sure.
Yeah. My point is that it's easy to dismiss the U.S. shale sector, but like I said, between higher recovery factors and maybe even higher pricing, it would be a bad idea to dismiss it altogether.
Yeah, it's not going anywhere. I mean, it's you can always infill, you can always do new zones, you can always do step outs. These are big areas that are being targeted, and many of them with, you know, in 3-dimensional space, right? Multi-zone layer cake. And so there's refracts, there's all these things that can get you resources. Just, again, it comes down to like at what cost, right?
And so speaking of costs, the tide seems to be turning back towards Canada because of our resource here. We've got a lot of low-hanging fruit that hasn't been developed the last 10 years. Are you seeing more interest in Canadian energy assets?
Yeah, for sure. I would say on the public market side, for sure. Historically, you had back in the day a number of US private equity firms come to Canada, and they struggled when it came to exits. Like, who are going to be the buyers of these assets after I've created value?
Mm-hmm.
And so, where historically it's been a struggle, there's just less players for you to sell the business to, right? But I would say that with the exhaustion that's happened in the US, for sure there's way more eyes on Canada, both from a public markets interest, but also a private company perspective, because it hasn't been picked over as much, right? But you got to get comfortable with
regulatory.
The regulatory. Like, that's what burned a lot of people before, right? Is a lot of the regulatory, the pace at which that stuff moved along, and it kind of forced everyone to retrench that came from the US to Canada back to the US. But given a lot of these funds have a lot of capital they got to deploy, I know for a fact that they're looking much harder at Canada.
For example, the Eventive deal to buy Vista, and they got rid of their Oklahoma assets, is interesting.
Yeah, absolutely. Like, again, it's like, Canada's massive basin, massive resource, low cost, and so
Baytex too.
Baytex as well. Yeah. Got rid of their Eagleford.
So do you see that happening more? Or do you see opportunity for the companies that are already in Canada to double down? How do you view that trend?
Yeah, I think it's a combination of both. I think you'll continue to see more and more interest in the Canadian space as a result, and even actually internationally and globally, as the understanding of the US and the maturity. Again, maturity doesn't mean you don't have anything to do. It just means it's well understood.
Mm-hmm.
And when something's well understood, it's hard to generate outsized returns, right? Mm-hmm. In Canada, there's probably still more opportunity to find tweaks that can help you with those outsized returns, right? And if you think about typical private equity model, right, they're looking for 15 to 20% IRRs. And so if you can look places where you don't have 100 other companies looking at it, right, you likely can differentiate yourself on an investment you might make, right?
And with LNG, what does the Enverus data suggest in terms of improved pricing for natural gas in Canada?
Yeah, I think our belief is, like, obviously LNG and the continued build out will continue to help. I think our current thinking is, so, like, the next few years are going to be a little bit rough. LNG, like, is going through a bit of a tough market itself, and typically you're, gonna in many areas you'll probably overbuild the infrastructure, and questionable whether or not there's enough resource to, supply that for the next 20, 30 years. So it'll go through its own volatility. But anytime you can create additional outlets to new markets, right, that always sets you up for, right, it's just supply and demand. It sets you up for better prices, right?
Well, it's the fall of 2025, November. As of today, where do you see Enverus headed with business and trends you're seeing and business lines? How do you look forward from here?
Yeah, I think, like, where we want to head as a business is, we think this is a multi-billion-dollar opportunity, right? Not AI wash, but we think, generative AI and the capabilities that are available with the best data foundation in energy, to us, the winners of the AI race are those that have the most and highest quality data assets, right? And I would argue Enverus has more data on energy than anyone else, right? Even if you're a super major, right? They only have a reflection of where they operate and their partners. We have a reflection of everything that's going on. And so it's not only that we have the best data. I would put we have a 600 to 700 person product data tech team, and I would put them against, forget about just energy, against any tech team or product team that's out there. And so our belief where the future is going and where we're investing is the generative AI capabilities that we're building out. How do we help every function within the energy industry basically have superpower? So how can we help a 50-person land team act and behave and make decisions like a 400-person land team, right? And we think with where AI is even today, and it's only going to get better, between all of the capabilities, the data, the analytics we have, we're already there where we can provide that value to our customers. So we think there's a multi-billion dollar opportunity around helping our customers be able to operate in a lean fashion and be able to have the operational skills and decision-making skills of people that are spending billions of dollars a year. So it's really, really exciting time for us. And then we'll continue to be acquisitive again from a standpoint of when we want to bring on capabilities or data or analytics sets that we don't have today, or we can create net new value for the customers. But this is energy is a hundreds of billions, if not $1 trillion market and industry. And so even though we might sound large at close to $1 billion Canadian in revenues, I mean, we're not even scratching the surface of where we can go from here. So
like we said, energy consumption correlates to human prosperity pretty well, and energy demand rises every year in all forms.
Exactly. And the reality is, I wouldn't pick a different industry to work in. It's quite rewarding knowing what you do actually impacts the global quality of life for people. If I worked for a company that built a CRM system or something like that, it's just not as rewarding, right? You can actually see the impact that you're having by enabling our customers that are the ones that are actually providing energy to the world. And so if we can help them do it more efficient and at a lower cost, then we're doing our jobs.
And the intersection of the opportunity in tech and the demand and the know-how and data from energy intelligence is a big opportunity for the company.
Absolutely. It's a massive opportunity, right? And we're just getting started. Every time you go through this is like when you're, I say this all the time, when you're no revenues and you get to 10 million, you're like, oh man, how am I going to get to 20? And you get to 20, you're like, how am I going to get to 20? So every year you're like, how am I going to do this? And then you get to 300, you're like, how am I going to get to 400? Then you get to, 700. Now we're saying how do we take this business to $2 to $3 billion of revenues over the next 5 years? But that's just an outcome of doing the right things for your customer, right? We're customer obsessed. We're customer centric. The result is, the revenues, which is what, everyone wants at the end of the day. But that shouldn't be the focus. The focus should be on how do you deliver value for your customers, and the rest will just fall in place from there.
Really appreciate your time today.
Yeah, you got it. I appreciate it, Trevor. Thanks for having me.